Good evening and welcome to the Portfolio Management and Quantitative Investment Strategies webinar, and a very warm and special welcome to our panelists, Eduardo Monrad, Stuart, Theakston, David Batalha, and Sylvain Forté. And also to the moderator, to Leonardo. And I'll present him in a brief moment. So my name is Carlos, as you see, Carlos Pinheiro, and this event is part of the Masters of Financial Analysis from the Lisbon Accounting and Business School, and I'm proud to belong to its faculty. So my master students are among the attendees, and so are some of my colleagues, namely from the managing body of these masters in the LABS. We have very topical issues to address, so with no further delay, I'll just briefly present Leonardo. As I said, we'll then present our renowned speakers. So Leonardo is an alumnus of the Lisbon Accounting and Business School, and a very dear former student of mine, and is presently earning his master's in Information and Systems Management at the Instituto Superior Técnico, a top university in Lisbon. He's also presently in Mercer, the consulting firm. So Leonardo challenged me really to create this webinar, as his interests in quantitative investment strategies are not only academic, but also relate to, I would say, his active participation in the market and with success. And I would say no more, Leonardo. So I give the floor to Leonardo, and is going to present our renowned speakers, as I told you, and I hope you all benefit from the webinar and from the talk from our speakers. So Leonardo, the floor is yours.
Thank you, Professor. First of all, I want to wish all of you to being here today and being able to assist our panel, and especially our guests that so kindly have accepted my invitation. I will start by introducing them. So David Batalha, he's the Chief Investment Officer of CaixaBank Wealth Management, Luxembourg. We also have Stuart Theakston. He's the Industry Marketing Manager at MathWorks. We have Edward Monrad, which is the head of equity market structure at Optiver Europe. And we have Sylvain Forté, and he's the CEO of Sesam. So before I pass to Stuart, which will be covering what quantitative investing is, I want to just give a quick explanation of what quantitative research or what quantitative investment strategies are. So it's basically employing portfolio management techniques that are systematic in a way that they are able to be replicable, and then being able to give you exposure to different things other than being 100% long only through an extended period of time, or short only. So I will pass to Stuart, which will be covering this in depth. Thank you.
Right, thank you, Leonardo. So I am hoping that you can now share my screen. See my screen, yes?
We do so.
Okay, great. Okay, so a little bit about me. My name's Stuart Theakston. I'm the Industry Marketing Manager for Financial Services at MathWorks, the maker of Matlab. My background is in trading technology, high-frequency trading, and quantitative investment management. I'm appearing in a personal capacity today, so these views are my own, not necessarily those of my employer. I have kind of chosen a slightly provocative topic to talk about just to kind of get us interested, which is entitled, "Why Don't Hedge Funds Make Money Anymore?" And then I'm just going to spend a couple of minutes at the end talking about Matlab. So without further ado, so what I'm really going to talk about here is actually, I'm not really just picking on hedge funds. I'm actually talking about any active management at all. So any sort of decision to buy one stock over another, any decision to hold a portfolio which is not the broad market portfolio is an active management decision. And the sort of industry term for this is alpha, which is kind of the value that you add over and above just investing in the market. And I'm going to make the case that this has become a lot more difficult, and I'm going to tell you why I think it's become a lot more difficult. So this is a chart from AQR, and I'm not going to go into all of the lines on this, but the line that we're interested in is the blue one at the top. And this is essentially the aggregate value add of equity long short hedge funds. Now, equity hedge funds they should be the guys who can outperform the market if anybody can, right? They can trade whatever they want, they can buy stocks, they can sell stocks short. So if anybody has any alpha, these guys should have it, right? In sort of finance terminology, they can have the largest active share, if you will. Now, if you look at the period before the global financial crisis, they did pretty well. So this is the blue line is the aggregate performance, and you can see that versus the benchmark, which is essentially equities with a little bit of equity exposure. You can see that since the global financial crisis, they've performed really rather poorly. And actually what makes this worse from a marketing point of view, not this is relevant to my argument, is that the S&P 500, for example, has been doing really well. It's had a Sharpe ratio of like 2, and that's very, very hard to compete with if you're a hedge fund, because everybody else is making a ton of money and your fund is just doing nothing, right? Now, if we bring that up, this chart ends in 2017. If we bring that up to date, the S&P 500 is up about 7% this year. I don't think if you'd have told anybody that the world was going to be like it is this year, they would have guessed the S&P 500 was going to be up 7%, but there it is. And the average long-short equity hedge fund is broadly flat when given that it has market exposure, a beta of about 0.5, it should be up 3 or 4%. So further evidence, just in terms of the widespread context, the chart on the left here is from Bloomberg, and it kind of shows the net rate of hedge fund formation. And as you can see, more hedge funds have been closing than opening for a good while. Most of the money that does flow into hedge funds now flows into the larger hedge funds. But if you look at assets under management for the hedge fund world as a whole, which is the right-hand chart, you will see that it's not really going anywhere. And when you consider that asset prices generally have been going up a lot, then the sort of hedge fund world's not sort of market share, but asset share, if you will, has actually been falling quite a lot. And when you go out into the sort of wider institutional equity investment world, there's a very interesting trend. And this trend is one away from traditional active managers who tried to pick stocks and outperform the market, and into passive investments, which are broadly just tracking a market capitalization weighted index. They're just buying the market and doing nothing. They're not trying to beat it. And you can see that this period after the global financial crisis is the period of time when this trend has really, really taken hold. And there's a sort of story that you'll hear that the rise of passive investing should actually make life easier for active managers, right? And in a sense, that kind of feels intuitive, because somebody has to do the work of working out which securities are misvalued and buying the ones that are cheap and selling the ones that are expensive. And the less people that you have doing that, the more alpha or return is available for active managers to take advantage of. And this makes some kind of intuitive sense. And there's a kind of argument there that passive investors who just track the market are somehow dumb money that active investors can kind of take advantage of, right? And I'm going to argue that that argument is completely wrong, and that actually the rise of passive investing is one of the reasons why hedge funds and other active managers struggle to produce performance anymore. And I'm going to do that with this very toy model that I've got here. I've chucked in a load of blasé assumptions about how markets work, but really what this is a description of is, imagine a world where all managers in the equity markets are active managers. So this is pretty much what the world looked like in, say, the 70s. So there were lots of mutual funds, lots of institutional investors trying to pick the stocks they thought that were best. Nobody had really heard of index tracking or market capitalization passive investing. There might have been a few mom and pop investors as well, but basically everybody was trying to beat the market, right? Now, the returns that those managers or those investors got, they're not necessarily a normal distribution like this one, but nonetheless, they're a distribution around the mean being the overall aggregate market performance. And the point is here that some investors outperform and some investors underperform, but the sum of the values on either side of the zero on this distribution must be equal. For every investor who outperforms the market, there must be an investor who underperforms the market, because the market in aggregate cannot outperform the market. So this distribution has to be equally decided in terms of dollar weight, if you will. And the observation to take away from this incredibly simple model here is that the winners need the losers, because without the losers, there isn't any winning that they can do. Now, when you introduce fees into the equation, so now I'm looking at this distribution from the perspective of the end investor. And I've been a little bit aggressive here and assumed that fees are 1%, which is perhaps pessimistic for nowadays. But nevertheless, I've assumed fees are 1%, and I've just moved this distribution 1% to the left. And this is how it looks from the perspective of the end investor, if you like, the hedge fund or active investor's client. Now, you can immediately see the problem here. The problem here is that it's even harder for me to pick an investment manager who's going to beat the market. Now, before fees, in a sense, it's easy to beat the market. Just choose an investment manager who's going to beat the market every year. It's probably a discussion for another day as to whether you can do that. But now we've introduced fees, you realize actually how much harder it is. In this 1% fee world, and returns of managers are normally distributed around a mean of zero, I've only got like a 16% chance of picking a manager who's going to beat his fees. So that's quite a big ask. And this is the realization that led to the situation where when somebody from Vanguard rocks up and says, you know what, why don't you just not bother to do this? Why don't you just get the mean of this distribution, if you will, the market return, but just basically don't pay any fees. And if you introduce, so this has a slightly curtailed vertical axis here, because I've introduced passive investors into the mix. And all I've done here is I've simply taken 80% of the returns in this distribution and I've put them in the zero bin. So these are passive investors who just buy the market capitalization weighted index. They accept average returns and they accept, and basically they pay no fees. And fees now for market capitalization weighted index tracking are very close to zero. They're essentially zero. So you can see what's happened here is that this has actually shrunk the entire distribution of available alpha, if you will, so that now the area of winners is even smaller than it was before, right? Because those winners need those losers, and those losers have essentially given up and decided to just track the market. And one of the key things that people don't fully appreciate often about passive investing is that it really requires very, very little trading. So whilst there are subscriptions and redemptions when money comes in and out of your fund, the actual trading that you have to do to maintain your portfolio weight is essentially zero, because market moves do it for you. There's a little bit of a misperception that index tracking is somehow sort of closet momentum strategy, that it buys stocks when they go up and it sells stocks when they go down. And of course, that's not really the case at all. Once you've bought your market portfolio, you never need to reweight, because just prices moving around do the reweighting for you. So yes, there are subscriptions and redemptions, there are IPOs, there are takeovers, there's the odd thing to do. But just to give you a flavor of how little trading these index trackers do, the Vanguard Total Market Index, which is an index of all US stocks basically, is an ETF. And so because of the ETF structure, from the fund's perspective, it doesn't really have subscriptions and redemptions. So if you look at the turnover of that fund, which is 0.03% of its portfolio, 3 basis points of its portfolio per annum, and you look at it's essentially zero turnover. You look at a traditional old sort of like a Magellan style Fidelity massive mutual fund back in the day, they would have turned their portfolio over 50–100% a year. So the passive investors have got turnovers which are sometimes several thousand times less than the active investors. And this is why one way index investing is not really a bubble, because it doesn't really need any trading once you've got your position on. But the available pool of trading to trade against, if you're going to be a winner, has shrunk enormously. And this leads to this, I guess this is either a kind of, it's either a vicious or a virtuous feedback loop, depending on which side of the accounting equation you're on, right? Where increased passive investing reduces the amount of alpha available for active investors. And of course, that makes active investing less attractive. So what happens? More people move to passive investing. And that again reduces the alpha available for the active investor. So there is this feedback loop. It's a very interesting conversation to have about like when it ends, because clearly somebody has to be there to keep the prices in line. But why is this useful when we're talking about quantitative finance? If you're learning quantitative finance, if you want to be a sort of hot shot quant alpha trader, then I hope what I've just told you isn't too depressing, but it is useful, right? And the reason why it's really useful is I think that when you're thinking about investing, you should always, and if you think you're going to beat the market, or somebody is telling you that they are going to beat the market, or you're telling your boss that you're going to beat the market, or you're telling your investors that you're going to beat the market, this framework of thinking about who the losers are is really, really important, because it does not matter how good your machine learning techniques are, how good, how alternative your data is, how highly optimized your factor timing regime switching model is, or how well you've manipulated the covariance matrix in your portfolio management process. When you put a trade on, an active trade on, someone else has to lose money. Someone else is taking the opposite view from you, a smart, well-informed trader with lots of data, lots of computation power. Why have they decided to make a different decision from you? Now, and if you can't answer that question, you kind of got to think, well, maybe I'm the sucker at the poker table, right? Now, you can sometimes answer that question quite well. So, for example, a lot of the things that classically we think of as risk premia, there's the equity risk premium, there's, there might be a premium for value investing, although who knows whether that's still there. There might be an illiquidity premium. And what's happening there is that other market participants are paying you a premium to take a risk that they don't want to bear, right? And that's fine. But the question you should ask is the premium, the return I'm getting for taking this risk, is this large enough compensation for taking the risk? Because sometimes it turns out that it isn't, right? That's possibly what's happened to value investing the last kind of handful of years. Or you're providing a service, like Edward, for example, is a market maker. So he provides a service which is immediacy of execution. So he gets paid for that, right? But it's hard work. He has to take some risk. He has to take timing risk on his counterparty's trade. His counterparty gets his trade done immediately. So this, I think, is like the key takeaway is when if you're building strategies, you're thinking about how you're investing, always think about who the loser is in that equation. Okay. Right, now I'm going to just quickly say a few words about Matlab. So I'm here in a personal capacity.
Sorry, Stuart, if you may, David was going to add something, if you don't mind.
No,
of course, yeah.
No. Let's
free.
go. Let's go for Matlab, and I will.
Okay,
kick
yeah.
in
Challenge me afterwards. Okay, great.
Yeah.
Okay, fine. So I'm here in a personal capacity today. One of the reasons I work for MathWorks is I'm a bit of a Matlab fanboy, having used it for pretty much 15 years. And you can certainly ask the very reasonable question, why would you use Matlab in a world with plenty of perfectly reasonable open source alternatives for doing quantitative finance? And that would be a very good and perfectly reasonable question. Certainly when you're learning a lot of these quantitative finance topics, you're just getting going, or you're more of a finance person than you are a programmer per se, then there's a much less steep learning curve with Matlab. It has kind of all of the usability and GUI driven approach to doing things that you get in some of the sort of econometrics and stats packages, and a lot of the flexibility and power of the more sort of computer programming sort of systems languages as well. And what I mean by this is when you're, any sort of task you're doing, you're loading up some data. There's an example here. It's like, I'm loading up some data. I'm looking at some summary stats. I'm filling it. I'm working out what to do with some missing values. I'm filling them in. And I do all that graphically. And then when I'm done, I can hit my generate code button and take that away, apply it to some other data, generalize it, scale it into the cloud. And I haven't really had to worry about all the sort of dull syntactical stuff while I was thinking about my problem. I can kind of think about that afterwards when it's done the bulk of the difficult work for me. And this applies across a lot of the functionality, a lot of the stats, econometrics, machine learning, data, and a lot of when you're learning quantitative finance, a lot of the examples you want to learn about, the papers you talk about in class, they're right there in the documentation, right? They're documented, there are examples, there are walkthroughs, there are videos. You don't necessarily have to think about, am I using this library for that problem and some other library for some other problem? And this applies across portfolio construction, backtesting and strategy development, risk management, value at risk, Monte Carlo simulations, algorithmic trading execution, machine learning and AI, deep learning, which is apparently what we call neural networks now, and things like reinforcement learning, which is quite cool for doing sort of like using machine learning for hedging options portfolios and things. And there it is, really. It's just the barrier for getting going, the on-ramp for getting going with some of these tools is quite a lot easier than it is for some of the other frameworks, particularly if you are coming at it more from a finance perspective than from a programming perspective. Okay, there we go. That was it. Right, now, David, argue with me.
No, first of all, I want to thank both Professor Carlos and Leonardo for inviting me for this webinar. I obviously want to talk a little bit as well to the students and tell them that everything that you just mentioned is real life. And you know what? When I was studying, one of the things that I really wanted to learn was, besides learning what we are being told and we are being taught, which is very relevant, is also understanding real life. And based on what you told, and to be honest, I do not want to argue now, because I'm very aligned with you, and there are only where I want to focus are on the winners, and we can identify winners, and it's very, very hard and very tough in this environment, namely on this interest rate environment, which I also think that justifies a lot of the things that you just mentioned. But first thing, guys, for the audience that is the part that is still studying, study a lot and make it worth. So when I say make it worth, is think by yourself, and really one thing that for me seems very, very, very relevant is try to identify the losers and try to understand how you can identify the losers, and try to understand that you are not the guy that will be losing in the poker table, because sometimes we think that we identify the losers and we do really, really big mistakes. But just looking here at one or two things that were mentioned is indeed, we first of all need to look at portfolio management in a different way that we looked in the past, and that's why I would like to challenge the other speakers, and I would speak at the end. But for me, as a portfolio manager, and from what I've been learning since I started managing portfolios in 2005, is that the world is somewhat different from what we learn in school, and schools are obviously adapting to this new environment. This new environment is very easy. It's the zero interest rate environment. We need to manage portfolios and to find uncorrelated assets that in the past were very, very easy to identify, and it's getting very, very difficult to identify. And what we see is that in terms of flows, indeed, flows are going very aggressively to passive management. And it's obviously that this flow is happening due to the reasons that Stuart highlighted. I would say costs is one of the main reasons, because people understand the cost of active management and understand that indeed the added value of active management is not as big as people expected. But it's challenging, and I would rather listen to the other speakers, and then I'll come back to you guys, because I believe that discipline is one of the most relevant things nowadays in portfolio management. There are several cases where we can identify winners, and I like to name it. First of all, I forgot to say one thing. I'm here speaking. Obviously, I'm CIO of the bank in Luxembourg, but I'm here speaking on my own risk and with my own views. Obviously, the views are applied in some situations and when managing portfolios in Luxembourg, but this is my personal view. But I would highlight you guys when looking at portfolio management and when identifying the winners to read a little bit about Terry Smith. Terry Smith is a English guy that when you start looking at what he does, he's a long-only active manager. His name is Terry Smith. He wrote a book which is Accounting for Growth, which basically they tried to ban the book. He's now managing more than 20 billion pounds. And when I look at the characteristics, I have a lot of what Stuart just mentioned. Look, this is a fund, long only, that has a negative turnover, which is something that Stuart mentioned, that most of the big houses do not have a negative turnover. And he's completely right, and I fully agree. Another thing is he doesn't do a lot. Why? Because he sees exactly that costs affect a lot when you are managing a portfolio, and you need to reduce your costs to a maximum because that can have a huge impact on what you are doing. And at the end of the day, what he has a lot is called discipline. And what we have learned in this world of portfolio management is having a tougher life with uncorrelated assets, because it's harder and harder to find an uncorrelated asset to manage a portfolio in an efficient way for the end client. Doing nothing perhaps is something that adds a lot of value, because not only you do not destroy value, you do not charge unnecessary costs to the client. So I always like to bring people that I think you guys should read a little bit about and look about. Terry Smith is someone that, if you have the chance to read and look at his fund, is worth. And I pass the word to the other speakers.
Okay, so I will invite Edward to talk a little on how portfolio management is quite different from market making. It actually has very little to do with, and it will provide an other view of quantitative finance applied to market making. Thank you.
Yeah, thanks, Leonardo, and thanks, Carlos, for organizing and hosting it. Thanks, Leonardo, for moderating. Yeah, great to be here and to speak with you all virtually. Here, of course, being the same room I've been in for the past 3 months, but that's the life we live in now. Yeah, I'm Ed Monrad. I'm from Optiver. We're a global market making firm. So one thing I always like to do on a, say, traditional panel is get the audience to wave their hands around. Luckily, there is a raise hands button here on Zoom, though I think for mobile, maybe it's a little harder, but we're going to give it a go. I want a show of hands. I think I can see them here. How many of you in the audience actually know what market making is? Maybe click the raise hands button if you do. See 3, 4, 5. More coming in. One of my 2 colleagues that's in the audience knows what it is, so that's a good set. There's the other one. Yeah, so some more are coming in, but I see, say, less than half, and I think that's fair. Market making is not always the same most headline strategy that's out there in the market, but it is, at least we consider, a very key part of market infrastructure and financial markets. So what is market making? Well, as the name implies, it's making a market. But what does that say? When you go trade a stock, if you want to buy, you generally buy at a price that's slightly higher than if you want to sell at the same time. That's called the bid-ask spread. You might see stock quotes. You might see something that's 4 euros at 5 euros. That'd be quite a wide spread, 25%. More commonly, you'll see something that's more like 32 euros and 95 cents at 32 euros and 97 cents. But same concept. There's a difference between the price at which you can buy versus the price at which you can sell. The difference in that price is called the bid-ask spread. And essentially what market makers do is show a bid at the price that others could sell at and show an offer at the price that others can bid at. In so doing, we aim to make that either, say, $1 in my €1 in my first example, or the 2 cents in my second example. Why do we do that? Well, to make profits, of course, but more commonly, why is it a function in the market? It's there in order to what we call provide liquidity, or as Stuart said earlier, offer the sort of automatic or guaranteed execution if you want to do a trade. Let me give you another, say, counter example. In the housing market, if you want to go sell your house, or say you want to buy a house, you have to speak to an agent, get somebody to represent you. You go around looking for houses that are on the market. Maybe you find one, then you start negotiating, and finally you've got something there. It's maybe a 2-3 month process. Same deal if you're selling. if one thing that's lacking from that market is market makers. What if you could go to a grocery store for houses and say, I want to buy a house, and boom, there's one on the shelf for you. Same if you want to sell. You go to a same grocery store and you say, hey, I want to sell this house. Boom, it's there. That might be a bit of a contrived example, but that's essentially how the financial markets work, the listed financial markets work. Those market makers are acting as that grocery store. So what we're doing is essentially, being there all the time to offer liquidity in the form of being always willing to buy and always willing to sell. Does that hopefully make sense to everyone? And by the way, if you have any questions, feel free to raise your hand now and jump in. I like to have these be as interactive as we can do in this time. So how does that relate to maybe some quantitative finance? Well, let's rewind back to 100 years ago in the 1920s. There weren't really computers. I don't think they'd been invented yet. So you might think there wasn't quantitative finance, but actually, if we look at some of the literature, and this is also, as you know, David recommended a book. This would be a highly recommended one from my side, and it's called Reminiscences of a Stock Operator. For those of you who aren't native English speakers, maybe a tough word, but it's a lovely book. It's about a guy who was essentially one of the first quants out there, and what he did was read the tape, which was a posting of all the trades that had happened in the markets, and looked at that and said, hey, I can divine some patterns from this. Those patterns in his head were quantitative in nature, and he was able to profit from it. He also had some downsides to his personality that led to an ultimate downfall, but that makes for a better narrative anyway. Highly recommend that book, Reminiscences of a Stock Operator. Hopefully, Leonardo, maybe you can share the book notes or the book titles with the group later.
Sure, will do.
But anyway, 100 years ago, we had quants in the market. Same deal. The folks that he was trading against were market makers. They said, hey, if this guy can make money doing that, maybe we should adopt that strategy. So they did. Some started to be more quantitative in nature, be more looking at what patterns were around. Fast forward up to the 80s and 90s, and you started to have computers really enter the financial markets. It started with some of the ECNs that were in the US initially. A famous one called Archipelago still exists in the form of the New York Stock Exchange's ARCA exchange. But they basically brought computers to the market. NASDAQ is also another famous market that still exists. It was originally a computer market. As those computers took over, more and more people were needed to program the computers. Obviously, that's highly quantitative, but what goes into it? We have countless factors, and every day you can think of more factors that go in and go in at a higher speed. The early exchanges that were computerized had maybe a couple factors, but really with humans kind of really still in the driver's seat. Every day, though, better computer technology comes out, and more markets come online, more types of trading come online. So if you then take a step forward another 30 years till today, here in Europe, we have, I think, 8 or 9 different stock exchanges that all trade European shares. In addition to that, we have, I think, about 25 or 30 what they call systematic internalizers. To avoid too much jargon, it's essentially individual investment firms making a quote on their own exchange, essentially. And you have alternative types of trading. Instead of an order book, you have maybe a request for quote market, or you have an auction-driven market, etc. So essentially, we have maybe 50 different ways of trading a stock here in Europe. In North America, it's even more extreme. What does that mean for quantitative finance and for a market maker? Well, a market maker needs to know what's going on and what is trading in what locations and in what size, in what quantity. How do you process all that data? That leads directly to quantitative finance. Simply taking in a lot of data sources, processing them in a quick manner, and coming up with an output. But more recently, we've even seen trends, and my colleague Sylvain will speak to this one later, but alternative sources of data. Historically, you've had the main types of data in the market have been essentially trades and quotes. Now we have trades, quotes, we have news feeds, APIs that you can get from news agencies. We have aggregated Twitter accounts. We have market sentiment. We have leading politicians throwing all kinds of interesting wrenches into the financial markets at all times. It's remarkable how much data is out there, and what we can do with it, I think, is only just beginning to be realized. Coming back to our business, it's very, very speed driven. Market makers, by benefit of constantly posting liquidity, are always essentially out there at risk in the market. If somebody knows something before a market maker does, even if they know it even a few seconds before we do, they can trade on that and they can basically profit from that. That's fair game. That's how the market works. In exchange, a market maker makes the bid-ask spread. But what does that mean if we want to stay in business? It means we've got to be fast. It means we've got to take in all the market data sources. We've got to take in alternative data sources that are out there. We've got to process them quickly, figure out what that means for a stock quote, and immediately adjust our prices or do our own trades off the back of that. If that doesn't sound quantitative, I'm not sure what does. So yeah, I think Stuart gave a bit of maybe a downer picture for some of the active or quantitative long-term horizon strategies. But in my mind, the quantitative and hands-on active trading is only getting more interesting and more relevant for a firm like ours. So yeah, I think it's quite an exciting time out there. I will wrap it up here. I'm not sure if any of the panelists want to jump in and ask me any questions, or certainly if there's anyone in the audience that wants to ask a question. And I'm not sure if the chat works, but raise a hand works as well. Happy to take questions, or you can always find me on LinkedIn and reach out there.
Eduard, if I may jump in, because also you just addressed market sentiment. And we know that, for instance, Bloomberg or Reuters, these service providers, they even have these algorithms very, very strong, very rapidly. They process millions of news and rumors and all this is aggregating, and these scores or these indexes, sentiment. Even in my research, I have been introducing these variables, these market sentiment or managerial sentiment, even because there are even before these providers did this work, which is, as you said, very, very beneficial for the industry as a whole. But you have like Duke University in the US that did surveys for as long as, I don't know, 40 or 50 years, quarterly surveys on CFOs from different firms across the world on sentiment. Do you think this is getting, because the overall finance of public economy is not new. What's new is really bringing this to the table of traditional financing markets. Do you see a trend of this information being more topical, and it's not topical, but more used even more and more? And does this make sense in terms of creating a more holistic view of like Stuart was addressing, this more holistic view of the agency of investors at the end?
Yeah, I think from our perspective, what we tend to see is anytime a new source of data comes on and becomes available or sort of invented as something that can be packaged and machine read and used in strategies, it's generally used kind of by a niche group, maybe one or two funds that invented it or came up with the idea. Then those funds, either the secret gets out when it works, or the secret gets out in the story of how they blew up trying to use it. But either way, others find out about it, think about it, refine it, maybe start to use it themselves, becomes more competitive. But at the same time, there's always innovators out there that, for whatever reason, aren't taking their own risk or managing money, but are looking to package that that data in a way that others can use. And I think that leads quite well to what Sylvain does. But you always see any sort of edge usually gets kind of commoditized and then brought out and available to more and more to use. And that sort of econ 101 type force goes in where some of the edge comes down, but it becomes much more accessible. Then others that otherwise wouldn't have had access to that start to use that data in new ways. And the cycle begins over again, new innovations on top of it. And so I think, yeah, these things are just continuously growing. I've heard stories of hedge funds tracking the amount of oil supplies by the shadows that were cast in the oil tanks because they had a floating lid to them. And they could see from satellite imagery that there was a higher or lower shadow in that oil tank, and were able to refine off that and trade off that. When you talk about now Starlink going up and Elon Musk being able to send up satellites, at fractions of the cost, you'll have funds putting their own satellites to generate their own data, and then off the back of that, companies will spring up and sell that data. So I think it's a never-ending cycle and just becomes more and more interesting for everyone to use in the end. I'm not sure, maybe Sylvain, you want to touch on it as well.
Thanks, Edward. You're right. That may be my cue actually to participate in the discussion. First, thanks everyone. Thanks Carlos and Leonardo for this invitation. We haven't met, but I really appreciated that opportunity to speak. I'm here in a more professional capacity. I'm CEO of a company called Sésame that is an alternative data company, meaning we actually create frameworks and data sets that we provide to hedge funds, especially hedge funds in the US, but also in Europe, in Asia, and also more and more asset managers, buy side, sell side, etc. And so our entire word is really this: is how can we profit from performing active management using new types of data sets? So obviously, I'll try to confront a bit what has been said by Stuart, and I'll defend as active management at least to some way. But I'd like to tell you what our vision is for that, and how we package that information, what's relevant right now in the market, and how it makes sense. And but by the way, Edward, the example that you mentioned on oil, using the shadow of oil silos in order to analyze how much oil there is, it is a famous one, but it's actually not really used in the industry.
The best stories are often apocryphal, aren't they?
Yeah, but I'll share a few slides, and you'll see that a lot is actually true. Sorry, just sharing the slides. So I won't spend time on Sésame as a company. Just for those that know us or not, we're a 50 people company. We're mostly based in France, but we work a lot in New York, Tokyo, and also in Tunisia. And we work mostly with quantitative firms, hedge funds, asset managers, etc. Not just the tier 1 hedge funds in New York, who are some of our clients, but also some of the less advanced ones that actually want to get in that market and to be part of the winning few percents that are actually leveraging these types of new data sets. So let me just share my screen, and I'm going to tell you a bit. So there is a logic to alternative data, and there has been this market has been growing massively over the past few years, and there is obviously a kind of trend and obviously marketing that is always involved in these new innovation in financial markets. But there are also real reasons why hedge funds are starting to leverage new types of data sets to create quant strategies. So the first thing that you should note is that there are currently thousands of data sets that are different from traditional market data and that are being used by hedge funds in the market. And some examples of that include, for example, obviously social media. Whenever the former President Donald Trump tweets, there is a market movement. Websites and news, whenever there is a significant news publication on a company, it immediately generates a movement, and that can be very quick. But also other types of data sets, such as weather reports, which are used a lot for soft commodities trading, geolocation data that is used in order to track consumer behaviors and to understand, for example, whether a consumer is going very often to, let's say, a company like McDonald's or a Starbucks, for example, and thus trying to predict in a better way sales of the company, satellite images, logistic reports, transaction history, credit card data, etc. And for each of these data sets, there is a story of a first hedge fund that started leveraging that data in order to build a small piece of alpha, a small quant strategy that could actually generate profit. And there is a tail of providers that have started selling that data, creating new data sets, etc., and making it a bit more accessible to the rest of the market. So with regards to these data sets, there are currently approximately 5,000 data sets on the market. They are being used mostly by tier 1 quantitative hedge funds. So what we would consider people that are generating alpha every day, actually being in that tail of a few percent of the market that is generating alpha every single day. These are the biggest consumers of alternative data by far. And the theory of why they want to use alternative data is because they believe, and we do believe too, that information is key. If you have more information than all other participants, if you have more information about a company than the company itself, then you have a very good chance of being part of the winners. Problem is, it is very, very difficult to be at that level of information, and it is becoming more difficult every day, which is something that is called alpha decay, meaning that the more a data set is used, the more it becomes publicly available, and typically the more an alternative data company is successful, the less alpha is contained in the data. And that is a huge kind of chicken and egg situation in the market, where the goal of a company is to provide a data set to as many market participants as possible. And the market is crunching signals and making sure that the signal disappears or becomes higher and higher frequency. So that is something that is happening every single day. But the truth remains is, if you're the first one to have a data set, if you have a very unique data set, if you have a very specific time series on which you can trade, there is an informational advantage, and you can actually generate alpha. And that is truth that is repeated every single day. Whenever a hedge fund puts his hand on a new data set, there is alpha that is being generated. So the logic now is becoming a bit different. As alpha still exists, active management still exists, but it's a matter of being the first to access that alpha, and also being the first to throw it out whenever that alpha is not relevant anymore. So making sure that the data set you're using is not the data set that everyone is using, but a data set that is really unique. And this is really a situation that is very interesting, because the underlying question is how much, it's not necessarily how much alpha is there in the market, it's how much alpha is left in traditional market data. And considering that everyone is actually trading on market data, mostly that this is 99% of everything that is invested, does it still make sense? Is there actually any alpha left in traditional data? I think that's the biggest question in the quant industry from an active management perspective, is that data that we are all using every single day still useful? And so I think that's a very big question. But in terms of alternative data, the key is you need to be quicker. You need to get access to the data set first. You need to crunch that data set as quickly as possible, which is why machine learning technologies, for example, are very relevant to quickly assess the value of a data set and to make sense of it. And you should note that some of these data sets are pretty hard to process. Imagine getting your hands on 10 gigabytes, or 10 terabytes of satellite data in image form, as you being used to dealing with C#, Python algorithm and the like, or a Matlab, for example, and suddenly having to crunch 10 terabytes of data. That's something that you haven't done at school. Or suddenly having to predict weather better than any weather channel, because that is how you will actually be able, using weather reports and satellite images, to predict the next trend in soft commodities market. So it's just that this task is actually very, very hard, and it's becoming harder and harder to generate alpha on that purpose. just to reassure you, I'm not trying to kill myself in this scenario, and I'm not trying to say that there is no value in alternative data, but I want to be realistic. Is buying the same data set and just thinking that the results will be consistent over time, that there will be no alpha decay is really unrealistic. So what's happening right now is a lot of hedge funds are first actively sourcing data set. So it's not just anymore about a hedge fund trying to create a new data set. It's now about hedge funds trying to systematically find as many data sets as possible and evaluate them as quickly as possible. And evaluating data sets is actually one of the key topics right now in the industry, because there are very, very few hedge funds that can actually evaluate more than 100 data sets per year, which is what you need if you want to regenerate your alpha pool on a regular basis, and if you want to actually capture the latest data set and the one that will actually create performance. The second question is, I think you see where I'm getting is, hedge funds are basically not creating a strategy that will be stable for 10 years. They are creating a strategy that will be stable for 6 months. And that cycle is accelerating. And so for quants, this is becoming more and more interesting. Rather than building a strategy and then sitting on it, that may seem the dream, but it's not. It's just you will have to generate alpha every single day. You have to find new data set, find new technologies, and find that small portion of data that still remains in the market and that someone will start stealing in just a few months. So that is really how quant hedge funds are innovating right now. The biggest hedge funds in the world, big US names, what they are doing is they have 1,000 different strategies. And for each of these strategies, they have a small data set or a small source of alpha that they are using, and that will be irrelevant in 6 months and that they will throw away. And their quant and data science teams are constantly crunching new data sets and constantly crunching that information in order to find new patterns. And so too many data sets is really an issue, because you need to evaluate hundreds of data sets. I can tell you there are, for example, there are very, very few European funds that can evaluate more than 10 data sets per year. 10 data sets gives you very little chance of actually finding something. When you find the data set, it's already being used. The second thing is, if you're a quant hedge fund, you need to create a lot of these small pockets of alpha. And the problem is, each data set, these are not market data sets, so they are not meant for trading. If you're analyzing satellite image and you want to track trucks, there are actually few companies that will use trucks. So your data set of satellite imagery is relevant only for 20 companies out of your 2,000 companies that you're analyzing. So a major issue is also that you need to buy a lot of data to get a coverage over your entire portfolio. And then comes the question of cost. Does it make sense? Can I buy a data set that costs 100K when my alpha factor will actually generate just 200K per year, considering that my quant salary has to be paid? So that is a real issue too. And lastly, well, not so many funds actually have time for that. So in order to really crunch that data and to analyze this data set and even to source this data set, it just takes time. So these are real issues and challenges. Hopefully, well, yeah, please go on.
Sorry, I need to challenge that. I need to challenge, and I've been listening, and I think it's the best for everyone. So first of all, speaking and arguing, I had the chance to visit to Sigma, to visit AQR in US. It's David. I don't know if it shows up. I'm using my mobile. I'm really sorry.
Sure. But by the way, so, David, just before we start the conversation, I want to mention that I'm more on the AI side. So I'm not a trained quant, but I'm more on the machine learning side, just so that you know my background.
Yeah, and all the arguments here is really to discuss and to look at it. But when we start seeing that strategies will work for a couple of days or a couple of months or a couple of weeks, the workload, the cost, and the salaries that are not small. That's why a lot of people dream about this business. It's because they're promised huge salaries. What we are seeing here is that there's a great business around this, and the business is perhaps around people that sell data or that collect information. But in reality, I've been working since 2005 managing portfolios. And reality for me is exactly what we saw in the first presentation of Stuart, which is show me the money besides the big fat fees that are being charged. Show me uncorrelated assets in a zero interest rate environment. Show me how can you help a portfolio manager making money or a client making money by basically using this type of assets. And what I see, to be honest, and let me just state this point very quickly, is I think that all have a very important role in the market, because market making is really important, and obviously everyone needs to get paid for it. And I think the role of everyone is very fair and very relevant for the market. At the end of the day, my experience tells me that we are adding a lot of volatility, and the accidents will tend to be bigger and bigger, not only because we are in a zero interest rate environment, because we have more and more people working, and more machines and more powerful machines working on the markets. And basically, I tend here to agree with Nassim Taleb, and more, I'm a deep believer of passive management, of active management, with a couple of guys, I can tell, not a lot of guys, but a couple of guys, and I can share, and this is good. I can share names without being attached to them, because our approach is an independent approach from the client perspective. So Fundsmith, a great guy, Morgan Stanley Global Opportunities, great guy, but a couple of active managers do it very well. And then I tend to be a follower of two things: behavioral finance, because people will, and it's more and more important, and I highlight to all the students, read the Nobel Prizes of behavioral finance, think fast, think slow, read Thaler, read all these guys, and as well read Nassim Taleb, because besides having a small group of people that do very well in active management, then you need to understand behavioral finance, because don't forget, you need to identify the losers and understand as well the market shocks will increase. And to help you on the third part, clearly Black Swan is a must-read book, because at the end of the day, barbell strategies will pay you, because what we see is that we have more and more players that will create more and more noise. And the picture of our webinar today tells us a lot. We see the spike in volatility that we had. And perhaps looking at all these strategies, I would add a little bit of Nassim Taleb with barbell portfolios. Clearly, having a very safe portfolio and investing a part of your money in barbell strategies that can pay you a lot. This because I challenge this panel of experts in working in real world to help identifying uncorrelated assets, which is more and more difficult. And as you just mentioned, uncorrelated assets perhaps will be for 1 week, 1 month, 2 months. And after that, the data will be used by several people. And the third thing is study psychology of investors, because the psychology of investors is behind. And the most successful people that I know are the ones that make the best use of how investors tend to behave, and that goes for Nassim Taleb. And the other ones are the disciplined people that basically, besides looking at data, look at profit margin, at operational cash flow, and that look for continued capacity to deliver operational cash flow in companies. So I would like to share with you guys that from a portfolio manager perspective, my life has been hell for the last 10 years, because I hear a lot of storytellers, and some storytellers keep telling me the same story, but not delivering returns. Still, they are very well paid. One day I'll be wrong. And the others don't tell stories, but are very disciplined. And what I will highlight is everyone has space and everyone is helping the market, but the market is getting more and more sophisticated. So prepare your portfolios for much more noise in terms of volatility. And for me, this is basically something that will not help quantitative, because when we are talking about strategies that work for a couple of months or weeks, we are far from the book from the beginning of the past century. We are far from the 80s, because the machine is playing a huge role against us.
Yeah, the sad thing is to say against us. You should work with the machine rather than against the machine.
No, on portfolio management, the machine is working in our favor in several things in the world. And look the way Tesla is working on it. and the founder of Tesla is working to provide data to people, to provide the satellites that can see.
Yeah.
When we come to portfolio management, I think zero interest rate environment and the speed of the machine is helping us a lot in terms of market making, in terms of providing liquidity, but in terms of creating portfolios is creating more noise and more volatility. Don't get me wrong. The machine is not helping from that point of view.
I just want, I think it's fair to have a bit of controversy in that discussion. I think it makes sense, but I want to comment on a few of the things you say. The first one is, you mentioned that an alpha factor that only lasts a few months is an issue. I don't really see it that way. I see it as there is a need to generate alpha factors more rapidly. And the situation where a strategy is generated and it can just stay like that for years, that really doesn't exist. That really doesn't exist, or it is a strategy that will not perform. And I totally agree with that. But I see that more as a tooling issue than it is really a fundamental issue in the market. It just means that people need to use the machine and to use algorithm in a way that helps them generate strategy. The strategy is not necessarily the end game anymore. The end game may actually be the tooling. And I think Stuart really illustrates that also with Matlab, is we need the right tools in order to make sure that we can generate strategies at a lower cost. And the cost of generating an alpha factor is a big question for our clients. Actually, when we're talking about let's say the winners and commas, etc., we're all thinking about the New York hedge funds, etc. These guys, they don't think they have invented something that will last for years and that is the perfect algorithm. They're just considering what is the marginal ROI that I get after I deduce salary from having created an alpha factor. So that is the real equation. And the ROI still exists. It's just that you really need to have a process in place to get it. The second thing is, I think it's really important to separate a few things. Alternative data, machine learning algorithms, etc., is not the same as high frequency tradings and as robots purely trading algorithmically on the market. There are a lot of quants that are making discretionary decisions, but there are a lot of data sets that are using on a low frequency. And there are examples where it makes sense to use alternative data for high frequency. I'm thinking about tweets. That's a basic example, something that you want to use at a high frequency in some cases. But the main part of alternative data is actually trading at a low frequency with just signals that are on a weekly or even a monthly basis, or even using alternative data in order to predict quarterly sales. So it's really very different, and the higher volatility, etc., in the market may have other factors than that type of new types of quant strategies that are emerging. And yeah, there are machines and machines, and high frequency trading machines, including in market making, are not necessarily the same as machines that are used in the context of quant trading. But other than that, I really agree. And I think the key consensus is it's getting harder and harder, but at the same time, there are more and more tools, there are more and more data sets, there are more and more ways to find that alpha. And the fact that the picture is a bit more blurry doesn't make for less work. It just makes for more work, actually. Everyone needs to find something, and that thing is more and more of a needle in a haystack, because there are so many available solutions. So
can I just come in here? Actually, what I think is interesting is that although Sylvain and David are disagreeing, they're actually agreeing as well, because I think Sylvain talks about the tooling, David talks about the discipline. Both of those are really about process, right? So, at an entirely different frequency, in an entirely different way, I sense that David's very interested in it. It's the investment, it's the process, right? So does this manager have discipline? Do they have a repeatable, disciplined process that they follow? And actually, that's a good measure rather than necessarily, a sort of short-term outcome. And actually, Sylvain's saying the same thing, in that in a sort of different area of the market, in a sense. How can you actually how can you come up with uncorrelated things, alphas, whatever you want to call them? The perfect uncorrelated thing is a thing that makes money and doesn't have any correlation to anything else, right? Well, actually, you really have to build a significant process in terms of quantitative and human infrastructure to do that. And in an ideal world, you would turn that into a machine, right? Is that, you know, the quant salaries wouldn't actually matter all that much, because the machines would be sourcing the alternative data and looking at the alternative data and turning it into something that the other machines can use from satellite images. And, you know, it would just be a cookie cutter that did this stuff. But all of that is about good process. It's a like completely different sort of process, and it's like a lot of machines and different sorts of data, but it's still about if you're going to have any value in this market, having a disciplined, well-tooled, repeatable process that you can understand, and that, you know, sometimes you need to explain it to others, sometimes you don't want to explain it to others, but that is a sort of institutional, industrialized investment process, and that applies all the way actually from market making through to sort of the big quant shops, and to the sort of the longer term, more discretionary management that David's talking about. Is that it's all the same thing. It's about having a disciplined investment process, and that's the only way you're likely to consistently, whatever sort of investing you do, the only way you're likely to be consistently in the right hand side of that distribution is by having a good process, because it's the people who don't really have that process who maybe are the losers, the people who are punting high volatility stocks, the people who are just trading indiscriminately because they have to, people who are panicking at the bottom of the market, right? These are the people without discipline, without process, without the tools to make the right kind of decisions.
Maybe just I think that's something everyone is really aware of that, but a key part of that process in many cases that I'm not sure that raises bells for a lot of you is avoiding overfitting. That's something that we observe. Of course, that's the case in our domain, but more generally, quantitative analysts are struggling with this every single day. It's a model that has been trained, whether it's just on a few parameters, on a few factors, or on thousands and thousands of different parameters with machine learning or even deep learning. How do I make sure that I'm identifying a pattern in the past that makes sense and that has a chance of being reproduced in the future, so that my strategy actually makes sense? And I think as part of it's a bit of outside the discussion, but I always find it crazy that when you speak to a quant and you present a backtest, the first answer to that backtest is, hey, this is overfitted, show me live trading. And in a sense, that makes sense. I think we've all seen every kind of backtest with a Sharpe ratio of 5 every single day. But
they don't go like that, right?
Yeah, but it truly shows an issue in the rigorous process that should always be applied. It means that people cannot really trust the tooling, and that the chance of overfitting is actually very high. And there can be two interpretations to that. It's either people are lying or people are doing something wrong. And there can be a bit of both. But truth be told, it's really a matter of having the right process in place, having the right tools in place. Yeah.
That's a classic example of having a good process, yeah. Right?
On average, the experience tells that they're lying or they're clueless, which in both cases is really bad.
Well, because you see a lot of lying to themselves, people, right?
Yeah, so they're lying or they're clueless. Having said this, machine helps a lot, and I fully agree that, first of all, discipline, it's very, very, very relevant. And besides discipline, the second thing, and that's why I would highlight to all the students that are listening to us, is knowledge. Knowledge is critical. Understanding what you are doing, understanding the machine, understanding how you can take the best out of the machine and from your models, and how can that help you? First, second, I would say that notice that the secret source does not exist, or until today, the secret source or the most wealthy people have something that will not give you access, where you have some hedge funds that are completely closed and you will not get access. And it's like, you can tell by the number, by the fingers of one hand. And on the active management as well, you don't have a lot, but people that are really successful are disciplined, and on the second step, they know what they're doing and they're using the tools in the right way. So focus yourself in learning and having a good background so you can use the best tools that you will have. You guys will have tools that are much better than the tools that perhaps we had 20 years ago. But really understand what you are doing and be very disciplined on your process if you are looking to be a portfolio manager, because with those two skills, you will have the talent. The other skill will come with the behavioral finance that you will learn and will see in the market. But don't get me wrong in any way, machines can be your best friend if you know how to take the best use out of it and you understand what you're doing. Backtest, please avoid. Don't use words as backtest, or even yourself. Don't believe at the backtest, because as you just listened from several people, strategies are getting faster and faster, completely worthless. So if strategies are in some cases being worth for a couple of months, backtesting is completely worthless.
Again, I think this should be nuanced just a bit, as if backtests are worthless, it means that there is an issue in the process. If the process is right, you should be able to trust your backtests. And again, the fact that a strategy is worthless after a few months doesn't mean that it is worthless. It just means that you need to be the first one to have it. And maybe on another topic, and just to get outside of that controversial matter, I just want to mention also that quant is not just about alpha. Quant analysis is about a lot of other things. And one topic that we have right now for a lot of quants in the market is, for example, the integration of new data-oriented constraints such as ESG, where all quant managers suddenly have to adapt their portfolio to new constraints from a sector perspective, excluding specific assets, having to rethink their entire allocation methodology, and having to stress and put constraints on strategy that are not meant for that due to some new constraints. ESG, by the way, is environmental, social, and governance factors, meaning that the need to exclude stocks that are outside of well-meaning environmental, social, governance framework, or actually having to include only stocks that are part of this framework. And this is another big topic right now for quant. It has been discretionary until now. It is much more quant driven, and we see that every day. So that's another topic that is less alpha driven.
And that's an excellent example of how quants can add value, not necessarily in direct alpha, right? If I can construct a portfolio which gives me market-like returns but has like half the carbon intensity, well, you know, who wouldn't want that, right?
Exactly. Thank you. I will just introduce some questions that were asked a while ago, and we just had the right opportunity to ask them. So this one from Professor Sacadura. In one hand, we have highly successful hedge fund managers with fantastic track records like Jim Simmons' Renaissance Fund with all their black box quantitative strategies. On the other hand, we had failures in the past with black box strategies and Ponzi schemes like Bernie Madoff. My question is why an investor should, in the long run, put their money in a quant fund who doesn't disclose any of their strategies?
Okay, shall I go first? Everyone else is on mute. So, so the first observation, I guess, about Rentec, which is like the poster child of this stuff, is if you're an investor in their fund, you don't get to well. So to start with, nobody on this call is an investor in their fund, right? Because it's only the employees and friends and family, essentially, and you don't get to compound your returns, right? In the medallion fund, they send you a check at the end of every quarter for the profits. So they know exactly how much their dollar alpha is, and they know exactly how much AUM they can deploy to extract that alpha. And when they've exploited it, they send you a check for the money, right? So that tells you some things when comparing them to people like Bernie Madoff. One, it tells you that they probably do have real alpha because they cut you a check at the end of every quarter for it. So, you know, that's money you can actually spend. And that's actually quite sometimes a useful guide as to how real these things are. The hedge funds who their performance tends to be quite mediocre become marketing machines, and you will see very, very strong AUM growth, but the performance tends to remain pretty mediocre, because if you have very, very strong AUM growth, you can't continue to make returns.
I would also say that I think if you're investing in a fund, it's fair to respect or expect some explanation of what they're doing. Certainly the investors in our company have some understanding of what we do, but it's sometimes not in the ethos of the investment fund to divulge their perceived secrets.
I'd say don't put all your money in any one fund, however good you think they are.
Well, I have a different opinion. Obviously, first of all, you should know what the person is doing and understand. It's not only about knowing; it's understanding as well, because otherwise, it's a matter of faith. And we have different religions in the world, and people have different type of faith. So, if he's not telling you what he's doing with his money, and he's not able to explain, and you just receive a letter, and for that you pay 20% performance fee, let's just be reasonable. How many things do you buy in life, or how many things are you willing to spend a dime of your money without knowing what's being done with your money, and getting a relevant return on that money with a certain knowledge? Well, money works really as all the other assets in the world. So if the question is regarding the quant question that I got from Professor Jose, I believe it's a professor, I'm really sorry, but I didn't have the time to look at it, is keep it simple, as we should always do in life, and only invest in things that you understand what the fund manager is doing, and that perhaps you don't have the tools to replicate, because then it's a matter of scale and a matter of having a way of doing. Other than that, you can invest, but you should not be surprised with an output that is not your expected output. It's just random. And if you're going for random things, just go and follow the Nassim Taleb approach, which for me is very wise. You know that you will have black swans. It's like paying taxes and dying. You know that you will have one. You don't know when, but you know it will occur. So just try to implement a strategy that you understand. And I'm really sorry, it's not about being against this. It's about 15 years without seeing added value to the end client. And one thing I would like to highlight to everyone that is looking to be a portfolio manager is don't worry about robots, because clients, they can fire you and they can hire you. But the first time a client will have a negative performance year to date, and clients are a very peculiar animal. They are persons like me and you. And 31st of December is the magic date. And if you go there and you show a minus 10%, he will be pissed off with you, but he will have someone to be pissed off with. If you say, well, I cannot explain because it was the machine with an artificial intelligence that did this shit, I'm really sorry for my language, he will say, what? My money is being managed by a machine, and he will fire the machine immediately, because he wants to relate with someone, he wants to understand, and typically he wants to understand exactly on rainy days, on days where the market falls, on days where the portfolio basically went south, and he wants to have someone behind him that can explain in an easy way what's happening to his money. So that's why also I have some problems with the quantitative, because from 15 years of experience, 2 Sigma AQRs, the smart guys from London, I never had an experience where I was given some help to explain, because to be honest, sometimes even the person that is running the fund does not know what's happening behind. So don't get me wrong, I'll be very glad to put this type of investment in a portfolio. But when we're speaking about real lives, real money, I really need to understand what's happening, and this advice we give to all clients and to all friends. And I just to share, I have this argue with Leonardo for the last 10 years of my life, and I'm just sharing with you guys, and I'm glad to learn every day. And if today is the day that I will be convinced that I'm wrong, I'll be the first one, and I'll be glad to be convinced that I'm wrong.
And just to add something, and in that case, going in the direction of David, if as an individual you can invest in a hedge fund, either you are very, very wealthy, or that fund is likely not a tier 1 hedge fund generating alpha, because if that was the case, the fund would not accept your investment. So if you can, you really shouldn't, except if you're looking at something else, which could be diversification. And if that's the case, the matter may be a bit different. And obviously there's that notion of how hedge fund strategies are correlated to the rest of the market. And that is by itself a controversy, but yeah, hedge funds that really generate alpha are really exclusive. So if you have that opportunity, it's likely that it's not the case.
Yeah,
Thank you.
don't buy what they want to sell you, right?
Next question. Does the alternative data have enough updates to be used in market making, tick by tick strategies? I believe this one is for you, Edward.
Yeah, I think it's a really good question. Let me explain a little bit how we generate a market making strategy, and then I think that'll enlighten like how we can use some of this data. Essentially, what we aim to do in general is to come up with what we call a theo, or a theoretical price, for a given financial instrument, and then we can use that as our baseline to make a market around. So say we come up with a theoretical price of €4.50 for an instrument, we might be willing to buy it at 4.45 and sell it 4.55, or it might be 4.25 and 4.75, depending on various other factors. But that theoretical price has remained constant. Now say that theoretical, and that price is fairly stable because it's usually based on a number of factors. And in the absence of new data, it stays the same. So if nothing happens, it remains 4.50. Then you essentially, you generate that and you constantly add to it. So every time a new signal from some piece of data, some source comes in to your model, you update your theo. Maybe maybe it's an oil stock and oil has just gone up in price. So you raise your theo by a certain amount. Maybe it's my apocryphal story and you see that the shadows are longer on your alternative data. So you, again, assume that there's less oil around, demand will be higher, you raise your price. You do that in somewhat discrete steps as the data comes in. So it's still quite useful for sort of an immediate adjustment to your theo, which then kind of remains the same going forward. Of course, your theo is constantly shifting because you incorporate many sources of data, but you don't need a fundamentally like minimum amount of updates in order for something to be quite useful. I hope that that answered. If not, Ruslan, throw it in the chat as well.
Thank you.
Maybe a comment on the dataset side. It's very, very rare to see alternative datasets that are not daily. Actually, a very, very large portion of the datasets are either daily or lower frequency than that. And it's very, very rare to have datasets that are beyond hourly, just due to the nature of the datasets there. Remember that they are not meant for financial markets in many cases. So it's you don't often need to have tick by tick data outside of financial markets.
I think if you aggregate a number of sources, and I throw in, say, like a news feed as an alternative source of data, any given piece of news is maybe a one-off even. That piece of news will never come again, but you have constant news. And so if you use that in a good way, you do have kind of a constant stream of granularity.
Yeah, that's actually exactly what we're doing. And Also, when you, yeah, we have around 3 million sources, so you really can get to that kind of tick level. But I'm just mentioning in general, from the kind of a few thousand data sets that exist on the market, you'll see a lot of quite low frequency data sets, and daily in most cases, but even in some cases up to quarterly. Yeah.
Makes sense.
Thank you. Really good answer. Okay, so I'll ask the next question, which is, first of all, I would like to thank you all for the brilliant explanation. I believe this was a previous previous question, and I take this opportunity to ask how we should use diversification to minimize portfolio risk. I would like to know how to efficiently combine risk and risk-averse assets. So, despite this question being relatively simple, it gets tricky to to be able to provide a sound answer that survives to out of sample testing.
Yeah, I mean, the problem is correlations are very time varying, right? So, you know, what's negatively correlated 1 minute. I mean, just look what happened in March for that like couple of days when bonds had the audacity to go down at the same time as stocks. It was like, whoa, you know, everybody's risk parity portfolio had a few slightly scary days. And that's like, you know, because, hey, we're in this bonds are negatively correlated to stocks regime. What the hell's going on? So, I mean, fortunately, order was quickly restored and, you know, bonds started going up again and stocks kept going down. So it was all okay in the end. But yeah, I mean, that's the perpetual challenge, right? If you find things that are uncorrelated, they're often, you know, it's very time varying, or they become correlated at exactly the moment when you need them to be uncorrelated the most, which is i.e. in the tails of the distribution. But that's life. If it was easy, then, you know, it wouldn't be any point, would there?
Okay, thank you.
I would argue if you're not a day trader, there is less and less if you are looking for a portfolio in this interest rate environment. What we still look forward, but it's diminishing, and I think this will as well touch the next question. But in real life, what we are trying to do for a medium and long term investor is typically long treasury, very, very long. And here you are talking about 30 years maturity, zero coupon or something like that, some gold. But look, at the stress days, you want to have cash. And because others need cash and they get executed in everything, fixed income, equities, and everything, you will suffer. So tail days correlation, it's useless because you will not find it. Or you just got the lottery and you bought the right options on the previous day. Other than that, forget about it. It doesn't exist. Other than that, for medium long term, you can add some long dated treasuries and some gold. Still, you're talking about the medium long term, because on the tail event, you just basically want to have cash.
Yeah, because everybody sells everything.
They're executed, so they don't even sell. Someone sells
the margin clerk. The margin clerk does it for them, right? Yeah.
and then you see the passive trading with a premium of 10%, and you want to have cash to buy this passive investment that is trading at the premium of 10% to the NAV. And but that is a matter of luck, and it really depends on how you want to manage. If you want to manage on a daily basis your money, or if you want to sit for the long run. If it's on a daily basis, then you go for the Nassim Taleb approach, which is a very good approach, very, very low risk. And you pray exactly for this moment. And on this moment, you will have the right options that will have a magnificent pay, and you will make a great amount of money. There was a question regarding interest rates, and on this I would like, perhaps I don't want to create some noise, but this question on interest rates, because this is what we hear from clients a lot and something that we are facing. It's not about expecting more interest rate cuts or not, but perhaps we are living a moment that in 15 years, 20 years, or 30 years, we will recognize as a change in the economic theory approach. I don't know if this is the moment or if it will come afterwards, but while my bet is that rates will need to stay low for long, and that we will need to apply a lot of supports to the economy, because otherwise we will have a lot of social unrest, and that's something that at one point might kick in, and we're already seeing that in terms of politics. So I think that even though I don't agree that perhaps what's happening, it's the so-called MMT, the modern theory of economics, one thing I recognize is that as of today, chances are that interest rates will remain low for longer, and that can happen due to the fact that we have a huge trust in the developed currencies. But we will be around, hopefully, to see if we are seeing a shift in terms of economic theory or not. Well, Japan is playing this game for a long time. The level of debt is huge, and still people trust the currency. So I think this is we are changing in terms of economic theory. But regarding the main answer, if we can see more interest rate cuts, I don't know if we can see more interest rate cuts, but I can clearly foresee a lot of support from the central banks and from governments, which in conclusion, my opinion is that even if rates are not cut, we will have an environment that will have very, very low interest rate for a long period, and banks will suffer, and more companies will suffer, but clearly the financial sector is suffering for a long period. This is my view. I don't know the rest of the panel, if they share or not. But
if I may jump in concerning this new, if it's not a new theory, at least it's a new environment, new world of negative rates in the monetary market. So whenever I teach these days, I have to recall that students, if they are even in bachelor's courses, they have lived in this world so far, and not me as an old timer there. I saw huge rises and drops and so on, so roller coasters. But in terms of this, so I agree with David, so we can adapt a new theory concerning this environment. The thing is that these days, financial institutions and banks from different jurisdictions, if all is negative, let's say in a simplistic way, if all is negative, okay, we can adapt even theories and practice. The thing is that we have caps and floors, and so this creates asymmetries, and also in terms of competition. Just to provide some color on this, for example, the Portuguese banks, they cannot charge a fee on deposits for customers, and if you go to our neighbors in Spain, in Switzerland, it's possible. It's because the Bank of Portugal, the central bank, doesn't allow us certain things, and so this creates these asymmetries and might, in a sense, have this arbitrage movement, and this is not beneficial for the financial markets at large. This creates these frictions between markets with this limit, this threshold that you can apply some strategy, and of course the net interest margin for banks suffers a lot from this. If you are from a jurisdiction where your levers are not as many or as flexible as around. But there is also a question from one of the students concerning, okay, the diversification, the one that you answered. The thing is that, of course, diversification even might be considered the closest to a free lunch, because the closest to a free lunch in financial markets. the thing is that normally the asset managers and you tend to have a common pattern in diversification. So when you have to sell, everyone has that diversified portfolio, and so diversification in aggregate terms in a downfall or so is not really kicking in. You have the same type of diversification, because there's also this. I might think there's also, I wouldn't say earning behavior, but okay, the tools, the data are almost everyone uses the same. What's your view as from the industry? So I'm speaking from the academic world, but from the industry, how do you feel this diversification is really diversification when you as you studied it in modern portfolio theory from Harry Markowitz, the Nobel Prize from the 50s in the last century?
Well, the approach, and that was why I started by saying, first of all, learn a lot from what you are being taught, because indeed, from an equity perspective, for example, the diversification, people tend nowadays to over diversify, and that's a problem, because a lot of assets are offered, a lot of strategies, and that's why more and more when we have accidents and we have volatility, we have spikes in volatility that are incredible. And that when you look at standard deviations, the standard deviation tell you, well, this should not happen in a million years or in a trillion years. So at the end of the day, learning all the theory behind diversification makes sense. The diversification will pay and will make sense on average portfolio if you basically are not a day trader. And this is the part where, again, I go to discipline approach, behavioral finance. And if you control your emotions, you are disciplined, and you have a good process, diversification will kick in a very good way. You just need to have time on your side, and you cannot have leverage in any way, because what you see is that in the tail risk, in the rainy day, in the day where you will see an aggressive movements in all the markets, you need to have a strong and solid portfolio. But then if you look to the longest period of time, which doesn't need to be that long, you will see that what you learned indeed still works. It's working less and less because of this interest rate environment. It's working less and less because you even being offered a lot of things. The things that you are being offered indeed do not offer that much of correlation, but we still believe that what is behind the theory makes a lot of sense, and evidence show us that it works. So overall, you can reduce the total volatility of your portfolio, or you reduce the risk of your portfolio if you apply everything that you learn from Markowitz, if you apply all the portfolio management theory, and if you are not a day trader. On the long run, it will make sense. The problem is that you have less, and even having more and more assets to diversify your portfolio, assets are getting much more correlated in the past due to this new interest rate environment. Still, it works, and it works very well, even though you have small periods. And what you see, and there was I will try to find this and share with Leonardo, gold and long dated treasuries, when investors are really afraid, tend to perform very, very well in a portfolio. The thing is, you need to play with very long dated treasuries, and then you are talking about very high durations, which will give you a gearing in your portfolio that will be kind of aggressive, but it will do the work, and the work is to reduce the total portfolio, the total risk of your portfolio. And my experience tells me if you have a solid portfolio that is not executed and you don't use leverage, it makes all the sense, and the theory applies as we learn in the university.
I think one of the challenges is that, like, everybody knows this maths, right? So uncorrelated assets get actually bid up because of their diversification value. So, I mean, unfortunately, markets are pretty efficient, right? So, you know, this is what, there are many reasons why long-term bonds are very expensive, but their reasonably robust negative correlation to stocks is one of the reasons, right? They're insurance and you have to pay a premium for insurance. Like the ultimate extreme of this is put options, right? So obviously put options on risk assets are the best thing to add to a portfolio from diversification point of view, because they are strongly negatively correlated in the tails with the rest of your portfolio. Thing is, they're really expensive. Well, of course they're really expensive because they do their job really well, right? So people pay up for them. And you know, that isn't to say that there's a point at which you just think, well, you know, I won't bother with any of these assets because markets are so efficient, there's no point. But you can go down, I think David mentioned over diversification, you can go down the rabbit hole of, you know, trying to find some kind of magical portfolio insurance type thing. And the thing is that, you know, if it works, it's going to be expensive. And that's the challenge.
Just maybe to open a bit of another topic, and I'm sure there are students that may be interested in this. Outside of this global discussion with regards to passive and active investment, and possibly also financial markets seeming a bit less interesting or a bit less exciting, remember that there are also new markets that are opening every day. There are new opportunities. I think one that is obvious is cryptocurrency market. I see a ton of former hedge fund managers and quantitative analysts that are actually moving to these markets where alpha is more of a low-hanging fruit. So that is really the case. I've seen major players emerge, for example, in market making with the ability to profit a lot more than in traditional market, at least in the short term, due to the number of players being more limited. But that's not the only case. There are other markets that are opening progressively. And for example, private equity markets and venture capital markets are leveraging quant expertise more and more, are backtesting more and more, and have started structuring their data so that it becomes possible to try and, to some extent, detect patterns. So I just want to mention that there are a lot of exciting opportunities around this, and that the field of quant analysis just got a lot bigger in the past few years. And so, yeah, there's not just existing markets, there's also these new markets, and it seems interesting.
Yeah, I would echo that. I think I touched on earlier how there's new exchanges being opened almost on a daily basis, but there's also new asset classes, you know, coming onto exchanges, becoming much more sort of professionalized or standardized, much more fit for quantitative analysis and quantitative algorithmic trading strategies. And crypto is obviously a big headline strategy, but even you know, boring stuff like fixed income continues to move more and more into sort of electronified markets that trade more actively, trade more liquidly, brings in a lot of new aspects to a very traditional market. And so I think that for me is, you know, I've stayed in the business for over a decade already, and plan to going forward. Every day there's a new challenge and something new, exciting. And when you have those sort of core skills that are valuable, it's always something. You're never lacking for interesting challenges. Rather, you're trying to figure out which ones to dig your teeth into.
If you're bored anytime, you can always become a data scientist. The skill set is really the same. So you always have that opportunity.
If I may, concerning cryptos, yes, I supervised a student from another university with a thesis on crypto. His Bible is to come in the next few weeks, and really futures on Bitcoins and so on. So there's really always these new opportunities of new asset classes. That's really. What about exchange traded funds that Stuart at the beginning addressed the transaction costs? Okay, So if markets were efficient in the sense that the investor might want to maximize its return, so ETFs, they combine the benefits of equities and mutual funds. I think also that some consulting firms they estimate that in 5 years time or so, these alternative investments or these products the ETFs will have a huge growth, which more weight in the market. What do you think as people in the industry? Do you see this trend for ETFs?
I think on this, I'll kick it off. We're amongst other things an ETF market maker, and we see just continued growth in interest in the product from traditional asset managers who want to use ETFs in place of individual stocks. Maybe they want to get a sector exposure that's a bit more efficient to trade. But also, and I think this actually touches on a question that I see in the chat here as well about personal savings. More and more retail investors, people investing for their individual savings account or retirement accounts, are interested in ETFs. And like you kind of touched on, Carlos, they are definitely a lot of kind of the best of both worlds of being tradable and continuously updated and quoted by the likes of ourselves, but also provide kind of a one-stop shop for diversification. And as I think Stuart mentioned in his presentation, charge you maybe 3 bips for the value. You can get the whole US market or the whole Europe market for 3 bips annually, which is great. You do pay some transaction costs getting into it, but I think on some of these liquid ETFs, spreads are normally 1 or 2 ticks wide, which is normally also like 2 or 4 bips then, so pretty minimal. So Pedro, I would say, to answer your question, at least for my own account, what I would do in that scenario, and I'll highlight this one, that Optiver is definitely not a personal finance advisor, and neither am I, but for my own account, I would take a broad-based ETF and just put some savings into that, and as you grow older, kind of balance that out versus, say, a fixed income ETF as well. And that's actually what I do in my PA.
And besides this, I completely agree. Be disciplined. Be disciplined and understand the market. The market is not against you. It's not personal. It's not about you as an investor. It's what it is. And sometimes this seems weird, and I don't want to look in any way paternalist, but believe me that perhaps if you have the capacity to be disciplined, you will be your best friend. And the worst enemies of the wealth that I met until today are the owners of the money with lack of discipline. So besides this great advice that you are being given, I will just add ETFs and be disciplined.
Yeah, I think probably everyone in the audience understands the magic of compounding. So it does work pretty well when you start early and continuously drip feed in.
Okay, so thank you all. We're reaching our maximum time. I believe we covered most of the topics that we wanted to talk about. I'm not sure if anyone wants to make use of the last minutes to mention anything that wasn't mentioned. And I leave to Professor Carlos to end our session.
Well, thank you very much, Leonardo, for moderating, and also the very the very useful insights and knowledgeable insights from Edward, Stuart, and Sylvain, and David. Of course, most of our audience today are students, are master students, although this session is recorded and then will be available to a very vast audience, because also in our both in Ishkal and our LinkedIn site. And so there was a huge interest, because really these are very topical issues, and with all your knowledge, you managed to make them simple, which is very difficult. To make things simple takes a lot of knowledge, and and also discipline in structuring and coming to this level of less knowledge of the people that are attending today. So this was for this year's course a first webinar on this topic. I use also what was said here for the Masters of Finance in Ishkal for this year and the forthcoming years, because they are really very interesting and very knowledgeable things that you cater to in such an elegant way and a succinct way. So I think I congratulate you, and I deeply appreciate all your participation and contribution in my personal name, but mostly on behalf of the Lisbon Accounting and Business School. So thank you all very much.
Thank you.
It was a great pleasure. Thank you.
Okay, let's do a repeat in some time. Thank you.
Thank
Bye.
you, everyone.
Thank you.
Take care. Thank you.
Thank you.